Good morning, good afternoon, and good evening, wherever you're watching. Thank you very much for joining us on our Manchester focused webinar today. We've got some exciting guests and topics to cover. So we will begin now. We've got a few people in. So a bit of an agenda so you know what you can expect today. So also I'm going to introduce you to the amazing panel today. We're going to give you a little bit of a property market update. We've got a mortgage market update as well. Then we're going to double down and focus on Manchester as a location and almost deep dive into that, and also release information on the new Manchester development that we're working on. So to introduce you to the hosts then, so obviously you've got myself, Andy Butts. I'm the New Homes and Investments Director here at Centric and Centric Invest. We're joined by John, who is one of our expat investment consultants. John, I think you're in Asia today somewhere. Sean was actually had a flight delayed, so I think we're going to carry on without Sean. John's going to pick up his slides. And then we've got Hugh Davis, who's head of global sales at Cert, who are the developer behind the development that we're going to be running. Hey Hugh, good to see you. And then we've got the social media guru, Sam Norris, who's the MD of Grand Union Finance, who's going to talk all things mortgage market. And look into his crystal ball and tell us what's going to happen with the interest rates. So good to have you all on board, and look forward to introducing you all a little bit later. So we can move. So in terms of an overview of the property market then, so there were a couple of big announcements yesterday. Rishi made a big announcement, got very wet in the rain. It's a bit like the Steve McLaren moment from the old England football days. But there's going to be a general election on, I think it was the 4th of July. I don't think anyone predicted that coming. And then also we saw inflation moving in the right direction. So a lot of thoughts from people and chatter on the grapevine around what that's going to mean to the base rate and mortgage rates. And I'm sure Sam's going to cover that off in great detail for us. So just some averages then. We like to give you a UK market update. Things have been pretty steady in the UK market, I would say, over the last 6 months. Average rents are continually on the rise, so there's still a lack of product or stock out there for renters. There's a lack of good quality out there in the market. There's huge demand and lack of supply, so you've got obviously the seesaw there, supply and demand. Average rents across the UK then are just shy of £1,300. Manchester, we're obviously focusing on Manchester today, but the average rent in Manchester is over £1,600. So you can see it's a hot market up there in Manchester at the moment for rentals. The average 5-year fixed when we produced this slide was running at 4.69. That's generally for a UK 5-year fixed mortgage. That moves almost daily, as I'm sure Sam will tell us, and he can bring us up to speed on a few of those pieces. Average asking price across the UK is currently running at 375,000. So still a very strong asking price, still very strong compared to pre-COVID. Even though things may have dropped over the last year, 18 months, we're still way ahead of kind of 2020 asking prices and in fact transactional values. Sales agreed, so we've seen an increase in sales this year versus last year by 17%, which is actually massive. It shows that last year I think a lot of people probably sat on their hands, probably didn't make the move for obvious reasons. And there does feel, from our point of view, I think a bit of pent-up demand, whether that's for investment, whether it's for owner-occupiers. I've seen it both in the industry, from a personal perspective as well. It's getting to the point where people are still looking to purchase property. And just average days on the rental listing market is slashed. So average property on the rental market is on for less than 25 days now. That's come down from pre-pandemic from 35 days. So you can see it's a really fast moving market for those buy-to-let investors. Next slide, please. We thought this was interesting, a bit of a forecast. This is actually Savills data. What you'll have seen this year, if you've kept your ear to the ground, is a lot of the big kind of conglomerate Savills, like Frank, JLL, CBRE. They were actually predicting a negative impact on the market this year, so -1%, -2%. After the first quarter, they've all come out and restructured those or reforecast, and pretty much every one of them is now predicting anything from a 3 to a 5% increase just in this year. What we've done there is given kind of areas. So we've got a UK overview. So Savills are predicting that this year we'll see an increase of 2.5%. And they're suggesting that over the next 4 to 5 years, so 2028, we're still going to see a 21% increase in the property value. We're focusing on Manchester and the Northwest today. So they're expecting a bit higher than the UK average, 4% for this year. So again, it's showing great demand up there in Manchester. And they think that over the next 4 to 5 years, we're going to see a 28% increase. So it does look like on a lot of the forecast that Manchester is the hot spot for investment at the moment. Okay, so if we move on to the next slide, I'm going to hand over to Sam to talk about all things mortgage market, and as I said, get out his crystal ball and look into the future for us. Over to you, Sam.
Cheers, Andy. Yeah, the old crystal ball thing's become a little bit more tricky to do in the last 24 hours, hasn't it? But yeah, hi everyone. I'm here to discuss really mortgages for you guys overseas, as you'll be hopefully using these or potentially needing to use these when you're acquiring assets on potential new sites up in Manchester. Yeah, Rachel, if you want to move over to the next slide. I'll just introduce myself. So my name's Sam Norris, and I run a company called Grand Union Finance. I set up Grand Union Finance 4 years ago. I've been in the industry for 17 years, although clearly my youthful complexion doesn't sort of follow on from that. But I set up Grand Union Finance really to help property investors because in our mortgage market, it's very sort of residential focused, and there aren't too many brokers out there that focus purely on helping investors. And we help obviously investors from all over the world, not just here in the UK, but we predominantly work with property in the UK. So if you are online at all and you fancy following any of our stuff on socials, you can find the tags down there. But I'll move on to first and foremost talking really about firstly a little bit about lender criteria for you guys. Then I'll talk a little bit about some ideas on rates. Now we have had some news on that, which I'm sure John will sort of go through in the first of his slides as well. But then when we get to sort of the last slide, which actually is just like a thank you slide, I'll try and get that old crystal ball out as we have had some news, quite a lot of news in the last 2 or 3 days, which might be a good opportunity to unpack, and we can answer any questions in the Q&A at the end. But let's talk about lender criteria first. So essentially, criteria is a way of compartmentalizing different applicants into different boxes. Different boxes generally mean different lending options and potentially different lenders and different products. So there are a few things to keep things quite high level and quite simple for now that you just need to be a little bit aware of, I should say. We as a country in the UK are highly regulated. There was some changes a few years back which made it more difficult for UK lenders to actually lend to those that don't earn in Great British pounds, which has reduced down our lending market to expats and foreign nationals investing in the UK. But those that do, we still have a decent market for those banks and lenders that do. These are the sorts of criteria points that they're looking at to pigeonhole people into certain categories as to determine whether or not they're going to lend to them. So have a little think about which sort of categories, which boxes are you ticking. The more boxes we tick, the more green lights we've got, the more lending options we'll have. So first and foremost is jurisdiction, where you're living. Certain countries will be more popular with lenders than others. Some big ones that are generally a concern for lenders that you wouldn't think are actually the US and Australia. That's generally due to sort of IRS reporting and all that kind of stuff. But the normal expat community countries, Middle East, Far East, Europe, a lot of these countries are on the green list, and lenders are quite happy to lend to those that reside there. It really is down to being in an open economic community. If it's hard to distinguish where you got the funds from that you're going to be popping over to the UK and investing in property with, then that's going to make life a bit tough for lenders. So we just need to be wary that wherever you do reside, you're going to be on a lender's green list, so to speak. What are you buying is also a very, very important thing that we need to discuss. Now, there are various different developments across the UK that you could invest in. The one that we're discussing today, obviously, is apartments. So apartment versus flat. If it is a block of apartments, looking at things like how many apartments are in that block, how tall is the block, how new is the block, are there all, what's it made out of, all of these kind of things that you might not even be thinking about are things that we also need to consider. Now, luckily, we're discussing a fantastic site today, which we shouldn't have too many issues with getting lending on, but it is something that lenders will want to know about. And this is, this could be a distinguishing factor as to whether a lender will or will not lend. Who is buying? Who are you? Now, many will, I think beforehand we discussed that we'll probably open this up in the Q&A to for a discussion on this about how you actually buy the property, whether it's in limited company or in personal name. Even if you borrow, through a limited company, and you're buying through a limited company, in reality, in the UK, that really is just, sort of a tax vehicle, if you like, and the lenders are still ultimately interested in you as the individual. We call you the UBO, the ultimate beneficiary owner, and it's you that they're interested in. They will want to know, whether you're financially secure, what your experience is, what your asset base looks like, and things like that. The experience, the history, the footprint in the UK can be also a determining factor as to whether they will lend to you or not. Whether you're an expat versus a foreign national, so if you have a British passport or don't have a British passport, again, can be a determining factor for certain lenders, not only in terms of whether they'll lend to you or not, but for those that do lend, which products you may have access to. Your income. Now, lots of people think, well, hang on, how much I can borrow on a buy-to-let mortgage might just be, surely that's just down to rental income and things like that. What's my income got to do with it? Now, generally speaking, we're not going to be running any kind of affordability assessments like we would do on residential mortgages, but lenders still like to know that you've got a little bit of cash in your back pocket, and a lot of lenders will have minimum income requirements, which basically is a yes or no question. If you hit a certain number, it's a yes. If you don't hit a certain number, it's a no, and it's as simple as that. There are varying degrees of this. For those that are based overseas, we do find that minimum income requirements to access the best lenders are that little bit higher, something in the region of £75,000 equivalent income usually ticks most boxes. So if you're above that, then you're generally going to be good to go on this type of criteria point. Anything less than that, you might see a diminishing level of numbers of lenders that we've got in terms of our pool of options for you. Now, obviously, I alluded to just before, in terms of how much you can borrow, it will be down to the rental income that the property is generating. Now, we're very lucky in Manchester. Well, in most parts of the UK, yields are relatively good. As we move through the Midlands up into the north of England and into Scotland, yields tend to go up. The higher the yield, the better chance we've got of getting the loan amount that we need. Generally speaking, 75% loan to value is what we're aiming for on these mortgages. In order to obtain that, even in the worst figures, terms and interest rates, the rental calculators will generally stack up if we've got yields above the 6% mark. So we're well looked after in Manchester. But let's go on now to talking about potential products. Now, we will go on to this. I could probably start alluding to this in a little bit more detail. We have had some really good news in the last 24 hours or so, which is that HSBC, obviously a very, very large lender here in the UK, has opened up very much its sort of overseas products and improved its overseas products. We are looking at things that start with a 5 again, rather than things that start with a 6 and a 7 and an 8, which we've been used to for the last few years. I wanted to sort of just give you a little bit of an overview, as this literally was from a lender that one of my brokers, Matt, recommended, and is doing a loan with a client that's based in Dubai at the moment. with just yesterday. So this is live data that he's actually provided over to me of just a breakdown of what their costs are at the moment, to give you a rough idea of what the normal sort of expat foreign national market looks like. We have options of different fixed periods. I know we're going to have a question later on about fixed versus variable, so I'll probably come on to that and go into a bit more detail when we discuss that. But in terms of 1 year, 2 year, 5 year fixed rate products, you can kind of see there where the average for the market is sort of sitting, and I would say this is quite normal at the moment. So yes, you won't be getting interest rates that those that are based in the UK are getting right now, but lenders will load their rates a little bit due to the extra due diligence and extra risk that they feel they're taking to lending to those that are not residents of the UK, not based in the UK. So based on your circumstances that we went through just before, based on the criteria, it will determine which lenders are available to you. Now, don't get too despondent if the best lenders in the market are not available to you right now. It could very well be that it's something that will you'll kind of elevate yourself through the levels of lending options, and you will get to a point where you'll have more lending options as we go through it. I always say to people, that purchase price is permanent, interest rate is temporary. So getting yourself a good deal right now before, as Andy alluded to, prices really start rising here in the UK over the next couple of years, and paying a not so nice interest rate for a short while could yield significant benefits in the long term when rates start to subside. Which I guess brings me on to talking about the news. So we'll go on to the last slide, which was meant to be my thanks for listening. I'll answer some questions later, but Andy has said, yeah, let's just quickly dive through sort of three things that I think are worth discussing before I hand over to John, which is I suppose going back to front. First and foremost, we have a general election that's coming up on the 4th of July, which also ties in, I suppose, to other news that came back yesterday, was that we had a significant drop in our rate of inflation from 3.2% to 2.3% yesterday, which on the face of it looks like incredible news for the UK economy. However, when you delve deeper into the and read between the lines, we were actually predicting a much bigger drop than we actually had, both in the CPI, the standard rate of inflation, and also the real rate of inflation, as I call it, which doesn't take into account certain volatile things such as food prices and energy. Now, as of course it is good news, but we did have the governor of the Bank of England say recently that they wouldn't be looking to reduce rates in the UK until they'd seen that we'd got close to that rate of inflation target of 2%, which obviously we are at now, although we are 0.3 above, and they were hoping to be much closer. In fact, some were predicting we might even go below it. But he categorically came out and said that they would need to see evidence that it goes down and it stays down before the Bank of England would be pushing for a base rate cut. Now, election aside, that's going to happen before that's going to happen after the next base rate announcement. But it's we will before then we are going to have another announcement on the rate of inflation, but the meeting of the Monetary Policy Committee will actually happen before that. So their next Monetary Policy Committee meeting is on the 20th of June, where they'll discuss whether or not we bring down the base rate. But the next announcement by the Office of National Statistics on the rate of inflation is a week later. So or it could be the day after. It's either a day after or a week later. I can never remember. But that data will not be available prior to the next announcement, which suggests to me that we would actually have to wait till August the 1st, which is the next Monetary Policy Committee meeting, to determine the Bank of England base rate, to see that drop. That's what the information that's being presented to us suggests. However, with the July the 4th election being announced, there is I think there's going to be a little bit of a scramble for lenders to get to get a little bit more market share before then. We could see a drop in interest rates as a result, which is obviously good for you guys that are investing in the UK, because I think there's going to be a little bit of a slowdown potentially in the market leading up to that, which could also then lead to a bit of a boom afterwards, which is good news. But it really does remain to be seen. Whichever side of the fence you sit on will determine, what your viewpoint point is on there. But and maybe this is a good point to sort of hand over to John, because I know his first slide will go through this as well. We did have some good news that, as I said earlier, HSBC have announced some pretty awesome rates, back down to sort of the 5% mark for those of you that will be eligible, which is going to be really useful for you guys that are investing, because with the kind of yields that you can expect on this project, John, it's going to be it's going to, there's some good profit to be made, isn't there?
Yeah, absolutely. Thanks, Sam. So yeah, guys. So look, I'm in Asia. I'm in Singapore today. I'm normally based in Hong Kong, but yeah, just literally 2 days ago, I got news of HSBC offering these rates from. I've seen the rate sheet. It's from 5% for up to 5 years fixed, which is absolutely incredible. I've been speaking to existing buyers and buyers in Singapore today about this. They're all excited. The £70,000 is the minimum salary start, which is one criteria, which not everyone will reach that, but most clients will. But this is extremely exciting. Most of my clients and our clients are actually buying off plan to complete next year. So, you know, they're buying now with the growth for the year, and the mortgage market should be in a lot better shape regards to rates. The fact that HSBC, one of the world's biggest banks, if not the biggest, is offering these rates is a sign of good things to come. So yeah, thanks, Sam. Appreciate. If we can move on to the next slide, guys. Right, we're going to talk about Manchester. So who am I? First, I'm John Treacy. I'm based normally in Hong Kong. I'm in Singapore, but I've been in Hong Kong and Asia for 17 years. I have always been helping expats invest into the UK. Over the last few years, primarily been in Birmingham and Manchester as markets, while London gets very expensive, yields are lower, stamp duty is much higher. These markets like Manchester and Birmingham offer this growth potential. And Manchester is, as Andy alluded to, is offering the highest potential return according to Savills of 28.8% next 5 years. So we're going to look at why that's of interest. Now you've got a huge retention rate from university students of 50%. So you've got the city's got things going for it. Oh yeah, you've got the two biggest football teams, arguably in the UK, which are advertising the city all day long. You've got this retention rate of 50%, which means people that go to university in Manchester, 50% stay in Manchester post graduation. So there's jobs and people like the city is my summary of that. You've got a huge ranking of inward investment, and you've got a lot of students there who love the city. So yeah, you've got a very strong economy, which is diverse. You've got tech, you've got finance, you've got students, you've got a young population, you've got a very forward-thinking city. Okay. So yeah, so one thing we get asked about is HS2. Obviously, HS2 is not going, that leg is not going to come to Manchester, but what they have done is invested a huge amount into the actual infrastructure of train network around Manchester, which is going to have a huge effect on that. You've got trams around part of the city as well. You've got, which is part of their integration of other rail schemes. So it's an enhanced connectivity, even though it's not HS2. And there's huge amounts of jobs being created. You know, most of the top 100 companies in the UK have got a big footprint in Manchester. Okay, thank you. So one of the big things that we do at Centric is research. We've actually done a huge survey with over 1,000 landlords and tenants, and actually we've asked them a lot of questions what they're looking for their property. And one of the big things that we got for Manchester was garden space, energy efficiency, and parking. And this, thankfully, this project we have at Osborne Yard ticks all those boxes. So we've actually got a research piece where people can actually download this. We're going to show the QR code, but we'll actually send this through in the follow-up as well. So if you'd like to scan this QR code, you can download this research, but we will send it in the next as a follow-up as well. Okay, next slide, please. So I'm going to pass over to Hugh, who's kindly joined us, who is representing Cert, the developer, who are based in Manchester.
Thank you very much, John. Welcome, everyone. My name is Hugh Davis. I head up global sales for Cert Development. A little bit about Cert before we go any further. I've been working now for the last 20 odd years in the investment and real estate development here in the United Kingdom. Cert are very much an investment-focused developer. Our head office is in Manchester. We've also got a smaller office based in Liverpool, and we're the developer of residential and commercial properties in the northwest of England. To date, we've completed over 500 residential apartments. We are currently on site in construction of around about 430 apartments. Across the various boroughs and cities, we have over 1,000 apartments currently in the planning application stage. But as well as that, we also work a lot with family offices and high net worth individual investors from all parts of the globe into the commercial real estate sector as well, with a portfolio ranging across, again, the northwest in excess of over £100 million. So, as a developer, we've come on leaps and bounds over the last sort of 6-7 years, starting off with our first project in Ancoats of sort of 28 units. But as I said, we've been involved in this market in the northwest in the development and investment field for nearly 20 years now. When I say that we're an investment-focused developer, we very much are. Okay, we're not just a builder. We're investing our own capital in these developments as well. We also have JV partners, joint venture partners. We also have equity partners as well. So we very, very much focus on the investment case behind each and every scheme that we do. A lot of our schemes, and you'll see from my track record brochure that John and his team will be able to provide, a lot of the schemes that we've completed thus far have been in, should we say, possibly the less desirable parts of town at the point of construction. But by the time construction has concluded, these areas are the new growth areas within the city, one of which I alluded to a moment ago, which was Ancoats. For those of you who don't know, Ancoats has just been voted the second most desirable place to live in the world by New York Times, a Time Out magazine, my apologies. So yeah, as a developer, we are now on site with Osborne Yard. Osborne Yard is the latest development that we are launching phase 2 of with you guys today and our partner Centric. Sorry, next slide, please. Osborne Yard is a 90-unit development consisting of 83 apartments, 1- and 2-bedroom apartments, and 7 townhouses as well. It also comes included with 53 car parking spaces. It's located in an area of Manchester which is undergoing a £4.5 billion regeneration by Manchester City Council called Victoria North. You can Google Victoria North and it will be able to tell you all about the regeneration over the next 10 years of the area itself. Osborne Yard is one of the very, very few privately owned sites within the location of regeneration known as Victoria North. This is with our investment hat on, the reason as to why we went out and acquired the land to build this site, because it ticks every box from our perspective and our partner's perspective when it comes to the investment goals that we're looking to achieve. Now, for those of you who don't know Manchester, the location, as I said, is just off Oldham Road, which is one of the main thoroughfares in and out of the city, as if you're heading north out of the city. You can walk to Ancoats, as I said, within less than 5 minutes. The Northern Quarter, which is the main creative hub for Manchester, it's where a lot of the startup companies are based. So its headquarters is myself. I'm located in the Northern Quarter. As well as that, you've got global brands such as Boohoo, Pretty Little Thing, Lad Bible, lots of other companies are headquartered out of Northern Quarter. And then you've got the main shopping district, all of which are within 15 to 16-minute walk of this particular site. As well as that, you've got transport. The airport is less than 25 minutes from the development. Okay, and obviously the most important one is Etihad Stadium, the home of the latest Premier League champions, Manchester City, which is around about a 5-minute walk from this particular location. Next slide, please, Rachel. So Osborne Yard at a glance, here we've got, as I explained, we've got 90 units consisting of 1- and 2-bedroom apartments with outside space, some of which you'll see from the floor plans have private gardens, some of which the gardens are bigger than the actual internal area of the apartments. We've also got balconies on the vast majority of the remaining units as well. Part of this, the reason for adding the additional outside space to the design of this building was we were we came up with the concept sort of post-COVID, where more and more people wanted outside space. Before that, the tenant demographic of Manchester wasn't too concerned about outside space, whether that be a garden or a balcony. Post-COVID, it's very, very high up on the criteria of the needs and wants of a tenant in Manchester. And so we've taken other considerations with regards to the tenants when designing the internal layout of the apartments as well. So, for example, with a lot of people now working from home, okay, 1, 2, 3 days a week, we've put a dedicated workstation in every apartment. All the apartments are slightly larger than your average new build standard sizing here in the United Kingdom. We've also allowed for additional things, such as additional power sockets for charging laptops, printers, scanners, everything else that's required that we've all bought since those lockdown days, and we're working from home. So we've got additional sockets, we've got additional USB ports, so people can work comfortably and easily from their apartment themselves if they choose not to go into the office. We are currently on site. We started ground clearing at the back end of last year, and all the meaningful work started. Here's some construction photographs here. These were taken around about 3 weeks ago. The groundworks have been concluded now. We completed the piling works on the site. Steel frame is going to go on site in the second week of June, and that's when things will really start to take off, once the steel frame is in place. We're very fortunate with this particular development in the fact that we have already sold 50% of the units in phase one of the when we launched that. We've got full funding in place, so this scheme is fully on course to conclude construction. I was notified actually last week that handover date is the 27th of June next year. So as a development, we're very, very confident in this particular scheme, and fingers crossed with the weather in Manchester doesn't hit us too badly, and we will conclude on time in back end of Q2 next year. Next slide, Rachel. So a couple of picks. I think John's going to come in now and talk about a couple of units that he's found within development. So I'll hand over to John, and any questions or queries, I'll be available in the Q&A towards the end. Thanks very much.
Cheers. Much appreciated. Yeah, so look, this development, as Hugh's mentioned, ticks all the boxes for us. And for this post-COVID environment, you can see one of the apartments has got quite a significant outdoor space here. So basically, we've got a range of one beds. There's about 10 one beds as we speak right now, ranging from 200k to about 235k. There's one which has got a 700 square foot garden, which is 250k, which is quite special. But this 313, for example, is a third floor one bed with a significant outdoor space, terrace, 550 square feet net internally, and a balcony as well, 235k. And that's going to rent for probably £1,100 to £1,200 a month, which will be about 5.8 to 6% yield. So very strong rental yield, which will look very good on the cash flow, especially for clients taking that sort of HSBC product that we talked about earlier. 404, and now to invest with that, you need £47,000, which is the 20%, basically. So you can invest there and get the mortgage with the rest. Is really a great opportunity to get into this market. We had a previous scheme in Manchester which all the one beds are sold out on, people missed out, so there's a chance to get these 10 one beds quite quickly now. Another pick on the one beds is 404, which is on the 4th floor. Another one bed, it's a slightly smaller unit, great for investment, but 210k. Again, it's going to offer a super strong yield of around over 6%, 6 to 6.4%. So these yields are quite special. They are actually higher than the likes of Birmingham, but by a little bit, give the purchase price and the capital growth potential. It doesn't have HS2 in Manchester, but you've got all of these great things that Hugh's talking about, and it all sounds very strong for the future. So there are our picks right now. Okay. So key takeaways, just to summarise what we've talked about this project. You've got a developer who's completely knows the market in Manchester, has got a huge pipeline in planning and pipeline to complete and pipeline for the future. So they're all, they know the market inside out. You've got a very low service charge, which is great for investors, which means you don't lose a lot of your money. There are some projects in Manchester which have been launched recently, which have got amenities like swimming pools, cinema rooms, which look great. but the service charge will be significant, and that will really eat into your yield. We're investment focused. My clients are looking to buy property to fuel their retirements, most of them. So they want to get the best yield, and this is what you'll get with the low service charge. Phase one was sold out, but phase two has got an equal spread of apartment prices and good apartment views. So it's basically second phase is launching tonight. So get in touch to discuss further. And just remember, if you're buying at 200 and it grows by 20% plus, just say 20% in the next 5 years, that's 240 in 5 years or 250 in 5 years' time based on these Savills predictions. So, you don't want to miss out. When the market when it becomes a lot cheaper next year, more people come back to the market. So you will be paying a higher price then. So get in touch to discuss this project. And we have got an incentive for webinar attendees. So if you get in touch with the next 14 days to discuss this project and your reserve, you'll get 6 months complimentary lettings and management by Cert themselves. So they're a developer that's all in on these developments. So they'll actually do lettings and management as well. So 6 months lettings and management. So for a 2-bed, that's circa £2,000 of savings. So quite an opportunity. So do get in touch at the earliest opportunity to discuss with our team about the projects, cash flows, best units, all that kind of stuff. And we can go from there. Thanks for that. Okay, guys, now we're on to the Q&A.
Thanks, John. Yeah, it looks a really exciting project. I think that that lettings incentive, like you say, is worth quite a bit of value. So yeah, if we could welcome everyone back onto the screen, that'd be amazing. So guys, if you haven't already, you can whack a question in the questions box. We've got a few that have come through, so I'll just pick through some of those now. But if we get time and you want to put some in now, we'll cover those off as well. First one here, so I think this is probably one for you, Sam. It's a question ultimately around to fix or not to fix, as the case may be. It's a question I hear every day almost. So yeah, to fix or not to fix in terms of a mortgage.
Yeah, it is a tricky one. I think based on what I've said in the short presentation, it's difficult to have a look with the crystal ball as to what's going to happen at the moment. And if you'd asked at the beginning of the year, you probably would have got a different answer. I think in reality, we are seeing at the moment that the tracker / variable type rates are being priced that little bit higher right now than fixed rates are. However, of course, they are going to be, if they are true trackers, they will track the Bank of England's base rate or the lender's internal base rate, which essentially is the same as the base rate. And if we are predicting that base rate is going to come down by a couple of basis points over the course of the rest of the year, then that will have a knock-on effect. I think for me, it's that crossover of at what point does what you're paying on a fixed rate now, would a tracker become cheaper than what a fixed rate is now? If you're going to fix in, say, for 5 years at, let's use some of those figures that were on my screen earlier on at 6.99%. If your tracker is at 7.99%, how long will it take for the base rate to fall significantly enough for your interest rate to then go below what you would be paying on a fixed? And are you, over the course of that 5 years, actually gonna benefit from that? And I think that's not necessarily, I talk about advice with a capital A versus advice with a small a. That really isn't advice for me to be given with a big A, because obviously every single person's circumstances are different. But advice with a small a is really do take these things into account. Just because you're in a tracker rate and rates are high at the moment in the UK and they are likely to come down significantly over the next 5 years, if not steadily, it doesn't necessarily mean that's still the best option for you. I am actually quite a big fan of fixed rates. I think it allows you to budget, particularly as an investor. If you are looking at your monthly cash flow, if you get a 5-year fixed rate, you know what you're paying for 5 years, and you know what you're making for 5 years. So for me, that's also something that needs to be taken into account. But there are lots and lots of variables, pardon the pun, to take into account with this, obviously.
Yeah, good. Okay, thanks, Sam. I think that answers that one. Second one we've had in then is around purchasing in a limited company or a personal name. Now, John, it might be worth you picking this up, possibly Sam, maybe to see what trends are or what benefits are. But I don't think any of us on the call are tax advisors, so I think we do need to be careful. But yeah, maybe some of the pros and cons we could cover off in the answer.
Yeah, so look, we are not tax advisors at all, and anyone should take tax advice. But for me, most of my clients, if they get four, seems to be the magic number for overseas buyers who I deal with. If they're looking to build a portfolio, basically, 3 or 4 or 5 in the next few years, then they'll do it. There is a tax benefit for British passport holders on the first property, regardless where they're based in the world. So, most people will do the first one in their own name at least, and then go from there. There are advantages for income tax. So, regards to buying in a company structure, if you look to buy that portfolio. But I've got clients who've got 7 or 8 and have done them all in their own names. So, yeah, buying a company structure does seem to be an on trend at the moment. It's a big thing for a lot of people, but it's just about probably taking that tax advice and thinking out what's your plan. Am I going to get 3 or 4 in the next few years? And if that's the plan, then they'll look at it. But it does have an impact on mortgaging, which Sam can allude to.
Yeah, it does. We're lucky. We've got a lot more lending options through limited companies, and actually a lot of the lenders that will lend to those that are based overseas can look at incorporated entities as well. The one thing I suppose that I would see as a little bit of a benefit, and as Andy said, look, none of us are tax advisors, so take what we're saying as small A advice, not big A advice, and that is that from a lending point of view, it's down to the rental calculation and how much you can actually borrow. If you are paying any kind of tax in the UK and you fall into that higher rate taxpayer level, and some lenders will actually even just decide, even if you don't pay tax in the UK and your income is based overseas, if you fall into the category of your income would take you to that higher rate taxpayer level, you do actually, when buying in personal name, have to adhere to a more strict rental calculator, which essentially means your rent needs to be higher in order for you to borrow the amount potentially that you need to borrow. So that's just something to take into account. It probably won't be too much of an issue for most of the people listening in, as most lenders, as I've said, it will be focused mainly on those that are paying tax in the UK on their income. But as I said, some lenders will just have a widespread sort of blanket criteria for that. So it could be something, but to be honest with you, the yields on this particular project and in this part of the world are good enough to usually be able to suck up those sort of more strict rental calculations that we need to adhere to.
Good. Okay, thanks. I think that covers that off pretty much. Okay, last one I can see here at the moment then is, so having been burnt in the past with investing in property, what security do we have to make sure this development gets delivered and we don't lose out? So I think that's maybe one for Hugh and John in terms of the deal structure.
I'll go first then, John. Yeah, I suppose it comes down, do your DD into who you're working with and who you're investing in. And ultimately, in that case, it's myself and Cert, our company. As I mentioned earlier, but I'll reiterate it, nearly 20 years of experience working in this industry, working in the Northwest, a proven track record, completed over 500 units, 430 units on multiple sites currently in construction, and there are over 1,000 units currently in planning. I could also tell you that we have grant funding from, the Greater Manchester Combined Authority and also Manchester City Council Pension Fund funding us as well. Well, they wouldn't be putting their money into our schemes if they didn't carry out their DD and have trust in the fact that we were going to deliver. Just unfortunately, they won't allow me to put that badge on my website. But in regards to this particular scheme, Osborne Yard, as I said, the development itself, we're fully funded already. We've got an agreement in place with Quantum Development Finance. I can provide, or John has the evidence of that. On top of that, we also have warranty when it comes to the standard of work. So your warranty provider on this is BuildZone. And in addition to that, one of our partners on the scheme is the contractor, Heatley Developments. It's the 5th scheme that we've worked with Heatley's on now. One of which was the one I mentioned earlier, one of the ones in Ancoats. They're on site with another 40 units, which we are doing it for a registered provider, a housing association. So as well as the apartments that Heatley Developments and ourselves have completed in the past, Heatley's have also completed in excess of 2,000 apartments for the various local authorities and registered providers and housing associations in the Northwest as well. So we also carry out the DD that's required to work with partners that we're confident can deliver what they say they're going to deliver. And that's the reason, because of the track record that we have with Heatley's, as to why we went with them as the contractor. And I'll be straight with you, they weren't even the cheapest, but it is the track record and the confidence that we have in them to be able to deliver as to why we actually ended up working with them.
Yeah, look,
So I think do your DD. Yeah, sorry, John.
Yeah,
do your DD. Make sure the professional team's in place, right? Yeah, John.
Absolutely.
Yeah, just like super comfortable with this project. The fact it's already 50% sold is a big thing for developments. That means it's we've got past the stage where anything it's a big part, 50% milestone. I'll be, as an investor myself, going into something that's 50% sold and then still some great apartments available to pick from is a really good position. It's in a safe place. So yeah, I think these got to be super comfortable with these guys.
I think as well, I'll just add in there, John. I'll just add in there. This scheme, we're well on course for construction. As I said, piling's done, steel frames been ordered, being delivered second week of June. This scheme's going to complete whether we sell remaining units or we don't sell the remaining units. It's just the people getting in at this sort of embryonic stage of the build are going to benefit over the course of the construction period. Otherwise, it's the local domestic market that will benefit upon completion, but at a higher price.
Yeah.
Brilliant.
Good.
Okay, cool. Okay, brilliant. Well, I think that sums up all of the questions for now. Guys, thank you very much for your time this morning. We will, as I said, we will share the link to this after the call for everyone that's registered, and it'll also be hosted on our YouTube channel. So do check it out if you've missed it today. But thanks for your time, guys, and look forward to the next one.
Thanks, guys.
Cheers all.
Thanks very much. Bye-bye now.